Welcome to Vishal and Company, where equity gurus own Vishal Tura, Taku Ndachena, Colin Botrell, and Maddie Grace examine the week's financial events in real terms, bringing the esoteric blur of public market activity into sharp focus. So come in, sit down, put your feet up, and enjoy.
And there you go. Hello. We're on.
Oh.
Hello.
I should have warned somebody. I didn't.
We're on. Welcome to this week's edition of Vishal and Company. Oh my gosh, guys. This week, Vishal, as per, is going to give us some weekly market updates. He's going to cover Janet Yellen, the former chair of the Federal Reserve's comments on the US dollar, the Bank of Canada raising interest rates, Blackberry, GameStop, Tesla, Netflix leading the Nasdaq on earnings, and Bitcoin falling back to EQUITY.GURU. TK is going to talk about some of the big banks' earnings and cover the Canadian Pacific and Canadian National Railway. We have Yellen here today to talk a little bit about the new administration. Yay. And the business environment that will result in, as well as the Facebook and Trump suspension. Yay. Again, it's a good day. And lastly, I'm going to put all these guys on the spot and ask them about their favorite ESG companies so we can all work to have the world not go up in flames.
Love it.
I am the resident, not finance person, to ask questions and keep all these guys in check if they're not making a whole lot of sense. And I'll shut up now. All right, Vishal, take it away.
All right, thanks, Maddie. Jam-packed show today. Quick on the equity indices. This week, as we sort of said with other weeks, still the uptrend, but it was more of an individual stock rather than an indice move story. And again, we'll talk a little bit about GameStop today, but we'll also talk about Netflix. That was pretty much leading the Nasdaq into all-time highs. But you know, this is the week performance: Monday, Tuesday, Wednesday, Thursday, and you can see today, Friday, the S&P is showing some red, but is actually seeing bidders step in again at our support zone. A price floor zone, and we have seen buyers step in there. But just a quick rundown here: S&P new highs, Nasdaq new highs, Dow Jones is the only one that is looking a bit weaker than the other two, the S&P and the Nasdaq, and actually you'll see in a bit weaker than the Russell 2000. So is this because, the Dow is lagging, which means it has room to catch up, meaning it's probably the best thing to go long out of the bunch, or is it some other, or is this a topping pattern, right? Are we going to see a double top pattern here in the equity markets? But we can talk about that a bit later. You guys know I look for patterns, and if I don't see that pattern, the uptrend is still in play. And as of now, all the dips are being bought. And then here is also on the Russell 2000. So what I'm going to be watching for next week on the Russell actually is our very famous head and shoulder pattern here. If this does roll back below and close below 2100, then I think there might be a short opportunity, which, again, the Russell 2000 is the small cap index. We do tend to see periods where the Russell moves first and then the large equities follow along. So we'll see if we get some fireworks here in the last hour of trading. But as of now, that's what we're seeing on the US markets. And let's just take a quick look here at the Canadian markets, the TSX Composite Index. As you can see here, we did actually break into all-time record highs, eclipsing February 2020 highs, but no momentum forward. We made the highs. The next day, we pulled back, got some buyers at support. But as you can see, for more than 2 weeks now, we haven't actually gained any momentum. So what we'll be doing is we'll be watching this support now here at around the 17,700 level on the Canadian markets on the TSX to see if this pops. And if you guys don't know, but the majority of the TSX composite is purely focused on energy, on oil. I think about 70% of the TSX composite is energy and oil. So, for us Canadians, we do have to look at the charts of oil. And Gail, and you probably remember back in the day, this day when oil went to zero, went to negative, and then a few shows later, we talked about this head and shoulder pattern and how that would have been a bullish sign. It was a pretty contrarian play by us, called by Equity Guru back then. Worked out really well, and in fact, we have actually recovered all of February's, like basically the COVID sell-off, right? The pan sell-off that began in February of 2020. We've now actually recovered it all. And
now, how do you think this is going to be impacted by Biden's removal of the Keystone Agreement, the XL pipeline, saying that not going to happen? What's that going to do?
Yeah,
how's it going to impact the industry?
Yeah, so that doesn't impact Canada, all right? Obviously, a lot.
Doesn't that impact Alberta? Because wasn't the Keystone supposed to be the entryway into the American market?
Exactly. So just a little quick background for you guys, or for our listeners here. Canadian oil. So the Alberta oil it's tar sand oil, right? And the thing about it is it's not seen as regular oil reserves. That's why when you look at countries that have the top oil reserves, Canada's not in the top 5. But obviously, if you include our Albertan tar sand oil, then it does become, obviously, it's like number 2. I think Canada's the second largest or third largest, right? But it's not like conventional oil. That's what I'm trying to say. It's very dirty to extract, right? And then not only that, you have to refine that oil. Canada doesn't have a refinery, so what we tend to do is we tend to send our oil to the US, who have the refining capabilities to refine our dirty oil, and then we buy the oil back from the US in order to use it for jet fuel or cars and all that kind of stuff. So it was pretty big because this Keystone pipeline would be sending more oil down to the States. And yeah, I think it is looking bad for Alberta. I personally think Alberta is going to secede, right? Like, we're in that process. I think if Trudeau...
They've been always saying that. They're not going to secede. I mean, come on. It's the modern world. We all jump up and down and go, we're leaving. But where are they going to go?
Well, they'll join the States, right? It makes much more sense for them to join the States and then to stay with Canada. I mean, to be honest, right? Like, it's not a jump up and down thing. It's more of a tax thing, right? In the past, Alberta's always carried the tax bill for Canada. And basically, once oil got hit, the current Canadian regime has done nothing for Alberta, but just basically prolonged its decline, right? People sort of forget, but Alberta was the second richest Western province or state in the world.
I grew up in it, and I grew up in the days of the Heritage Fund, and I benefit from those Heritage Fund. But you know what they did with the Heritage Fund? They pissed it away. They did nothing they didn't do anything like Austin did. They didn't rebuild a new tech atmosphere because they knew that resources weren't going to carry the day. And they actually thought ahead and planned an economy that would not be solely based on resources. And Alberta never did that. We just sucked the cream off the top, and when it stopped being the payday, we ended up going in the hole. So I don't think Alberta has any right, to a certain extent, to point fingers at the remainder of the country for the situation they're in.
Well, I mean, the other example is, of course, Norway, right? Norway has a fund, but of course, Norway is an entire country, right, where Alberta still has to pay federal taxes. And that's the thing, right? I mean, believe it or not, BC is in the same boat too, right? And it's not because, again, it's not because we want to separate, but it's more because BC's economy is based off of commodities as well, right? Real estate is getting there, but I mean, real estate really doesn't add much to the economy. But BC is all about commodities. It's all about lumber. It's all about mineral resources. And basically, when the Bank of Canada, which again is purely focused on Ontario and Quebec and a lot of other, they do focus.
No, absolutely do, right? But that's the manufacturing district of the country, right? Western Canada as a whole, as you said, is all commodities. Right? Yeah. We're the bread basket and the resource center for the country, right? Yeah. So I don't know.
But I'm just saying, right, this is the reality, right? We can't just look at fairy tales and stuff. But the reality is the secession movement, not just in Alberta, right, but in BC, it's going to happen because again, it's money, right? That's what it comes down to, money. At the end of the day, people forget when Canada hiked interest rates back a few years ago. It wasn't just Albertan companies that felt the pinch, because now their interest payments were, up by 100%. But there's also BC companies as well, right? The lumber guys and the mineral guys, right? So you can't just you can't just look at Alberta separately, because yes, oil is huge, but BC plays a large part. And of course, what we're seeing here with oil, again, major resistance zone, and what I'm looking for is a potential decline here in oil prices, back down to $50 or $49 a barrel here, having our pattern. And again, folks, the bullish case for oil has been, it is the real COVID vaccine play. A lot of people have said that because the vaccine is here, things are going to reopen, but not only reopen, we're going to see unparalleled travel demand. People are going to be flying places because they're going to be saying, hey, I got to get out of here. I want to live my life. And that really has been the bullish case for oil. And of course, you can throw in the OPEC production cuts as well. They are maintaining production cuts.
Is everybody adhering to those production cuts? Or is Iran and Russia just producing whatever they want to produce?
Yeah. I mean, the Iranians, again, they never adhere to production cuts, right? Because they've just gotten access to European markets and in Asian markets. So for them, this is all about game theory, right? So generally, OPEC production cuts don't work, because we got to remember OPEC is a cartel. So if Saudi Arabia, if Russia, if Iran, if they cut production, but the demand for oil, and when I mean demand, we're specifically talking about the Chinese. If the demand is still high, there's an incentive for these countries to cheat, right? Okay, you know what? Oil prices will cut the production, will raise prices up, but hey, we know that the demand for oil is still high because the Chinese will be buying. So why don't we cheat a bit? Why don't we make a few more barrels and charge it at these high prices to make money, right? What happens is word comes around, and then everyone starts to produce oils again because they know that this person's cheating, that person's cheating, and we get back to the equilibrium. And the reason why the Saudis are very ticked off is because the Iranians have stolen market share, right? Because if the Chinese demand is still there and the Saudis do a production cut, or the Russians do a production cut, and the Iranians step up to create more barrels, what they're effectively doing is they're stealing Saudi Arabia market share, right? And again, that's why the Saudis really want the Iranians dealt with, because they're losing their production cut. But that's the reality of OPEC. OPEC is a cartel, and it really is the Saudis that are taking the brunt of it, right? They are the ones that are doing the production cuts most of the time. And it's very likely the Russians and well, we know the Iranians are cheating on the production cut, right? But it's very likely maybe the Russians will too, because Galen, again, I think this was back in the day with me, you, and Arth. It was before COVID, but when there was that big plunge in oil.
Yep.
I don't think it was in 2018. I'm pretty sure it was in 2019, but that was because, remember, a lot of people were saying that it was the Saudis trying to punish the Russians, right? Because they were cheating on that production cut. So there are,
weren't they at that point also trying to beat down the American shale oil?
Shale, yeah. You want to explain a bit about that again, like how shale,
well, I mean, it's an unconventional source of energy, right? That America seems to have a fair bit of. Problem drawbacks being that shale oil is difficult to get at. Needs fracking, which in and of itself is problematic. As far as
it requires a high price of oil.
Yeah, it does, right? And not necessarily too high, but high enough, right?
Yeah.
Not as high as it's needed for, let's say, tar sands, because they need a really priced barrel of oil to make that work, right? Don't they need like about 50, 60 a barrel?
Yeah.
And are they ever going to get that again?
Well, we're there now. Again, the bullish case is people will say that the technology will improve. We'll just have to wait and see if the technology improves to make it more efficient and cheaper.
But the other thing about the oil sands, not the oil sands, sorry, the sedimentary basins that they're getting this fracking oil from is that they've hit peak production.
Yeah.
Right? So there's not a lot left.
And I'm sure we'll cover shale when Maddie talks about ethical and sustainable investing too. Quick front here. So I just want to go from oil to the Bank of Canada. But you guys know we've been talking about this currency war. All these banks want to cut interest rates to try to weaken their currency. But a guy from CIBC, I believe it was, their Forex or the currency strategist here. Sorry, no, it's BNP Paribas. Mm-hmm. But he's saying that, hey, you should be buying Canadian dollars because it's actually undervalued because it is a petro currency, right? The loonie is correlated with oil. This guy here believes oil prices are moving actually much higher, and the price of the loonie hasn't actually adjusted to the likelihood of a stronger oil price as the economy recovers. And what he's actually saying is Canada will not be cutting interest rates, but they'll actually be raising interest rates. He thinks that the Bank of Canada will be the first major central bank to raise interest rates because stronger commodity prices, oil, and decent economic growth will force our governor, Tiff Macklem, to confront the inflationary pressure sooner than other nations. So, very interesting, in my opinion, because we know how much debt has been issued by the consumers and the government. And, if interest rates do go up, it would be it would be a pretty heavy toll, right, to service that debt. So,
are we talking a catastrophic move or just painful?
Well, it would probably, it would just be 25 basis points, obviously a hike, very, very slow tiptoe up. But again, when you factor that into the debt levels, a hike like 25% can be fatal, right? And this is really the reason why the Europeans and the Japanese, who are negative, can't even hike by 25 basis points, let alone probably 10, right? Because of all the debt that they've had to issue. There would be issues, servicing all of that with even an interest rate hike. So, I'm not saying that they're going to hike, but I just think this is a very interesting take. And to me, it plays a lot in this currency war, with the US dollar and the loonie. I am looking for a long here. So I am thinking the loonie is going to depreciate against the US dollar at a break here above 127.80, which might see a move all the way back up to $1.30. And it's funny because we just heard from Janet Yellen, who I believe just today was confirmed the Treasury Secretary, but she's mentioning that the U.S. does not seek a weaker dollar, even though we've seen the dollar, weaken quite heavily in these since last year here. And, TK and I have talked about this and the currency war and why you would think people would be running into the U.S. dollar in order to buy U.S. dollar stocks or to run into the reserve currency as the whole world and the real economy starts to fall. But we haven't seen that. And a lot of people have said, it could be because the Fed is actually trying to weaken the dollar. And I bring this up because, we've heard this type of comment before. Not from Janet Yellen, but from the European Central Bank, right? From Lagarde, mentioning that, we don't want a stronger or a weaker euro, but we do have to pay attention to the euro getting stronger because, of course, we are a trading nation and we do want to boost our exports. So just another day in the currency war. And as I said, I do expect this kind of stuff to happen. TK, any comments about the dollar?
No comments now, but just buy the cheap US. I think it's a buy. Right? I'm still pretty strong on the fact that maybe in the next few years there will be more, variation between different countries and what kind of purchasing power you have.
Right.
But for now, it's safer to go with the economy that can tax 350 million citizens and some of the most profitable companies in the world. I'd rather take that bit right now.
I think so too. I think we're going to see a dollar run here, but I'm just waiting for the technicals to back me up. What I'll end with is I want to do a little discussion here quickly on the retail traders versus the institutional traders.
My favorite.
TK talked about GameStop, and let's just see the craziness today. It was actually halted because the stock jumped up and hit $76. Opened today at around under $43. Hit $76. And folks, this is what we're seeing, right? This is the retail crowd, the people that are getting government stimulus checks, opening Robinhood accounts, joining Wall Street Bets here. So this is Wall Street Bets. I want to show you guys, look at this. GameStop. Some guy made 17K on GameStop today. GameStop all the, bleep posts are going here. Citra. And so this is the one that we'll talk about. If you guys haven't heard, but Citron Research are one of the most famous short sellers. And they said that they are short selling GameStop. And this is what they were met with today. A big short squeeze. So, what I want to talk about is this whole battle against the retail traders now basically invalidating all the fundamental analysis of these large institutions who've been shorting, companies like GameStop, who've been shorting companies like Tesla, who've been shorting companies like, even Blackberry now. So Blackberry, folks, just to let you guys know, it's on the radar of the Wall Street Bets guys. If you scroll down, all you're hearing is, look at this guy made 26K on his GameStop here. But there you go, Blackberry joining GameStop very soon. But that's all that Blackberry was mentioned 1,000 times on the Wall Street Bets Reddit last week, and it is the number one talked about stock on Wall Street Bets this week. But I think GameStop might just overtake that because of what's going on today. And you can see here, it's all BlackBerry, and it's all Palantir is here now. But this is the new market, folks. So my question is, does fundamental analysis really matter?
In the short run, it won't. In our day-to-day, it won't. Because honestly, we know when you think about it, the fundamentals come out every 4 months. You don't know half of what's going on with BlackBerry right now, or unless they make press releases.
Exactly.
So a lot of it is just people making bets that, for lack of a better terming, some other idiot will hopefully buy this at a higher price.
That's basically it.
And that's the game. If this is the game that we're playing, I'd rather play it. But it's foolish to go.
How can you like this is the battle, right? I don't know if you guys saw, but when the Citron Research guy put the video out about why he's short selling GameStop, I mean, you won't see it now because everyone's celebrating it.
Yep.
But you guys were all attacking it. They're like, hey guys, it's time to create a short squeeze now. Let's all buy, and we're talking about a board here that has 1.9 million degenerates, right? Right. So I mean, these guys are creating these short squeezes, and it's if you're the guy, Citron's not commenting now about GameStop because they got cucked. They got a short squeeze the hell out of GameStop.
Yeah.
Right? I mean, look at this.
He's probably losing a lot of cash, but this is now my argument where I support fundamentals, even in the short term. With a short, it's an asymmetric return probability chance happening. It's a stock can go to zero, and that's capped on your short. But a stock going up can go to infinity, theoretically.
Yep.
And that's kind of what you have to think about if you're shorting. A lot of people felt that pressure with Tesla, with this guy. He's a famous short. He shorted a lot of the tech stocks in 2000. I'm forgetting his name.
Jim Chano?
Yeah, Jim Chano. Yeah. He shorted the tech stocks in 2000, and now he has a fund that just runs focused on short selling.
Yep.
But he's made a career out of it. But it's a difficult short to hold when the entire market is telling you you're wrong.
Yeah, exactly. Or when the Wall Street bet guys are against you. Yeah,
with the Wall Street kids, 18-year-olds with Robinhood accounts and leverage that reaches the sky. And it's hard to sit there and say, Tesla is losing money. Well, not anymore, but the the stock is too high, it's overvalued. It might make no sense,
Yep.
but it's a weighing machine in the long run and a voting machine in the short run. So we'll see.
How long can these institutions hold on to these losing positions? You know what I mean? Like it's.
Oh.
I know some buddies who are short sellers, like in the institutions, and they're very angry.
Well, just explain to me again, because GameStop is literally a brick and mortar outlet for video games, correct?
Yeah.
Okay.
Yep.
I see Nortel, I see Blockbuster, I see all of that in this.
Yeah.
Right? It's an antiquated.
That's actually
format.
what I called it.
Yeah, it's an antiquated format due for falling off the cliff. Just because a bunch of Robinhood investors have decided right now to change that fate, it doesn't mean that in the long run it's going to do business. There's a lot of people making money right now, and they will continue to do so as long as Robinhood just rides the hell out of it.
Rides that train. Yeah, it's so true.
But as soon as they, like Blockbuster, figure out that there's no revenue coming in, nobody's going out to buy video games from the store, then eventually they got to close their doors.
That's
So
true.
by the way, these guys are aiming for $300 per share on GameStop, by the way. So
How
that
do
is
you make
absurd.
that happen? That is absurd. That is truly uneducated. As far as
I think I should kind of point this out. It wasn't something I realized. It was of all people, Jim Cramer on CNBC, who pointed this out. He said Citron Lemon, or whatever the short seller's name is going to be beaten by the Wall Street Bets guys. And people are like, this is Jim Cramer. What is he going on about?
Yep.
And he a couple months before, he was talking about Tesla and these other stocks. And the main reason why we're seeing such volatility is because a lot of the buyers are using leveraged instruments to do the buying. A lot of the short sellers are using the same. So they're taking the opposite bet on some of them naked shorts as well, where they actually don't own the stock and they're just shorting it. And, that's their obligation to buy the stock at some future price, etc. Like, seeing your net worth reduced by 60% in one day is not easy. But if you
the comment here by the Wall Street Bets guy, Citron is starting to look a lot less like a research company and a lot more like a guy tweeting from his apartment.
That's what I mean, man. It's not easy to do it. And you have to kind of be away from the market to kind of do well with it. So I'm on his side. I believe in his theory. I just would never short or buy naked puts.
We have a quick comment from one of our viewers. It says thoughts on a bubble not popping because retail traders are spreading their bets across the market rather than in one sector.
So that's exactly what we saw today. When I was watching GameStop, when they halted it, I was like, okay, I'm going to look at Blackberry now because that's the next stock that all these Wall Street Bets guys are looking at. And I mean, it made weekly highs today because the money was leaving, or was not leaving, but was focused on GameStop and now was looking at Blackberry. So these guys are going to be creating short squeezes, around the market. So this money is not going anywhere anytime soon. And I do think it's something that we should pay attention to. And I just bring this up because I know a lot of institutional guys that are very upset because their models, their theories, their fundamental analysis is basically going out the window because this group of Wall Street Bets and Robinhood short sellers are creating these short squeezes and are taking them out. And I do see this happening. We're going to see stocks. And this was an argument I made in actually one of my Blackberry articles way back in December. But we are going to see these Robinhood guys and these Wall Street Bets guys looking at cheaper price stocks. And what I'm talking about cheaper price, Blackberry's at $13, quite cheap. You can buy a lot, and a lot of people are going to be looking at this thinking I can make crazy gains and retirements and all that kind of stuff. And I do see that. I see more of that going forward. And I think the question is, and one of my friends actually talked about this, who's in the Wall Street community, will government come down and say, okay, retail traders cannot trade options anymore because of these price discrepancies we are seeing? It's not a real market. Wall Street obviously has a big lobby group. The banks have a big lobby group. they can do that if they feel that they are getting cucked by the Wall Street bets guys. So that's something, I'm not saying it's going to happen right away, but I think it's something to definitely keep in mind.
True.
Right?
But again, this just shows an inefficient market.
Yep.
I don't know. It's like when people, pose the theories that they have on how efficient the market is, you kind of need to realize on a day-to-day basis with all these smart people looking at the market, it's hard to know what stock will do what or where this will go next week or the week after. People know Tesla is not, or Tesla and GameStop is not doing well or might not be as big as it's supposed to be. But you can't make that bet right now, especially with the market sentiment being as bullish as it is. Not that alone, but the president, is he president-elect? No, he was inaugurated this week, saying, hey, I'm going to push in another $1.9 trillion into the economy. Hopefully you guys go buy groceries, not make bets on GME or or Tesla. But we know what most people are doing with it.
What we're going to do,
with it. But it's like, it's hard to control. But if I was holding that short squeeze, the short in this squeeze, I would say, hey, just hold on tight. It's going to be a bumpy ride.
We also have a question from one of our own. He goes, thoughts on Yellen taxing unrealized capital gains?
Yep, that's what I was going to actually bring up, because that's what the talk is. And we know this, right? This is something we talked about with government spending so much money. No one's asking where this money is going to come from, but it is going to be taxed. This is why I've always said, right, inflation is taxation. All this nonsense, you hear about government officials saying we want living costs to be cheaper. They're all lying to you, right? We all know that they can't allow things to get cheaper, especially here in BC, because they need higher prices for real estate, because it means more property taxes. They need higher prices for oil. They need higher prices for goods, because it means more sales taxes, right? So these taxes are how these governments are going to survive in order to, spend money like they are spending. And that's the next thing, right? The unrealized tax gains. That
would be disastrous.
It's going to be a disaster, and I think this administration they'll do it, right? Because people don't understand, I think, the whole idea of wealth and how savings is investment. And just a little side, but in Japan, they did this 30 years ago, right? But they didn't do unrealized tax gains just for capital appreciation on investments. They did it for real estate as well, right? So that's how they got a lot of, they had a crazy real estate bubble in Japan 30 years ago. I think everyone's heard about that. And what the Japanese government did, the Liberal Democratic Party, by the way, what they did to bring down the bubble is they did unrealized taxes on real estate. So if you were owning real estate and your home was going up, you had to pay unrealized taxes every year, plus the property taxes, which caused people to sell their properties. And this is also why Japan is now predominantly a rent economy, similar to Europe. Right?
That does just promote short-term. If you're taxing people on long-term capital gains at the same rate as short-term gains, the economic cost of trading is basically the same for both strategies. I rather do YOLO calls than do a long one.
Now, would the taxing of unrealized capital gains also put a pin in the bubble?
It would cause more bubbles, I believe.
You think so?
It would cause more bubbles.
My guess is that it would drive up inflation, correct?
With inflation,
it's releasing
depends
that money.
on
Because it's releasing that money that's been locked into the stock market that we're never going to see. That is just this make-up money that we've made, and now it's putting it back into the economy.
People's hands.
Are we going to see an inflationary push?
People kind of did that in, not to bring up the 1920s, just before the Great Depression. That was kind of the Roaring 20s. It was households for the first time in American history were coming into the market. And this was a market that had asymmetric information. So some insiders had more information. People weren't reporting it quarterly and that kind of stuff. But now there's no information lag. which makes it a little bit more interesting to see how the bubbles are forming. And that's where social media is. If you get the narrative going on social media, everything else outside of that doesn't really matter. You can form a bubble in any asset class. So it's like some of that money might not even flow to people. People just reinvest it back or continue holding other bubbles or other.
And just to back TK's point, we've seen that in Japan and Europe, right? So this is the whole idea of inflation. People forget that one of the key elements of inflation is money velocity, right? Getting people to spend money. And that's why it is seen as much more of a psychological component. Again, I'm more of a classical economist, and we look at inflation, through a psychological lens. That was the whole idea, right? To boost inflation in Japan and Europe. All these taxes, all these unrealized gains taxes, negative interest rates, to get people to spend money because you're punishing them to hold money. But what happened is they actually began to save more, right? Because people want to buy property, they want to send their kids to school, they want to go to vacation, so they have to save money. And if you're creating these type of punishments on people, right, taxes, you actually end up saving money rather than spending money. So this is again, this is the whole big government and now these central banks trying to manipulate the economy and all that kind of stuff. And this is the thing, right? This is the reason why people are now saying MMT is going to be the big thing, because you're literally putting money into people's hands saying, okay, now go out and spend that money rather than saving that money, right? So that's the way that they're going to try to bump up money velocity, because
the old system doesn't seem to be working the same way. Money is not flowing as it's supposed to.
Yeah.
It's actually something Vishal has been talking about a lot, is we're probably going to experience another great wealth transfer. To those, and just another one, but it's a cyclical thing. It happens every 10 years, every century, etc. But there's always a massive wealth transfer. And that's why I believe in my definition of a recession. A recession is an economic period, a downturn, where money is returned to its rightful owners.
And again, folks, wealth is not destroyed, it's only transferred.
Yeah.
That's a big key point to realize.
Now, I got a question here from one of our viewers, and I don't know if I'm going to be phrasing this correctly because I just want to make sure I got it right. His thoughts were then buy asset management that invests in major trading, i.e. Goldman, Morgan Stanley. Trading cannot stop from retail in that situation. Does that make sense, this question?
I think that's what basically TK is going to talk about the banks. We've talked about this too, right? Where banks are making, I think it's their best profits in a decade. And it's not because of their regular business, which is lending money, but it's actually because of their trading and investing aspects.
Departments. That is true.
Yeah.
That is true. I think if, not to make a poker reference, but if you're playing poker, the house always wins. Each transaction, the house wins. So I'm going to go with the banks on this one. It's probably, they just reported this quarter and full-year results as well. And I just want to go through quickly some of the estimates that analysts have and some of the estimates that I came up with. So, for example, the one that's probably more talked about is Morgan Stanley. Outside of JP Morgan, etc., and Goldman Sachs is Morgan Stanley. The CEO's rhetoric right now is we had record profits from all of our departments, but specifically our trading branch. And the trading branch is both the brokerage and some of the other trading facilities that they use. So a lot of a lot of the wealth management and custodian services are making money because a lot of people, institutions involved, are getting into the market. I mean, I've heard companies buying into Bitcoin, and they do that through these big banks because they have large volumes of cash that they need to put through, because there's nothing else to reinvest in right now. For example, Tesla, couple months ago, raised cash from equity raisings.
Yeah, they
and
didn't
that
put a
cash,
damn dime against their company.
they just went straight into
Investing.
treasuries.
Yeah.
Treasuries, I think. Yeah, they went straight into treasuries, and to push that kind of volume, they had to go through their banks and whoever their main prime banker is. Morningstar is the rating agency. I think it's an online rating. Just has a consensus price for each stock that it watches. So for Morgan Stanley, its estimate price is $75 a share, and I think the current price, or when I last did this, was around $74 per share, something like that. The price I came up with was $42 per share for Morgan Stanley. And yeah, I want to open up a short, but I would never do that to myself. The more interesting one was Wells Fargo. For a lot of people who don't know what's happening with Wells, there was a scandal.
There's always a scandal.
5 years ago. They basically created an account and upsold their clients. So, for example, if I had a bank account with them, a checkings account, their personal banker sold me a savings account and a retirement account, gave me a credit card without my permission, which goes against some of the consumer protection stuff. So they've been kind of having a bad few years because of that, and market sentiment is pretty negative with Wells. On top of that, there's a documentary on Netflix titled "Dirty Money," Wells Fargo.
I saw the HSBC one. I haven't seen the Wells Fargo one.
Yeah, there's a Wells Fargo one as well. It's just like the sentiment is not great for the company. The CEO they've gone through 3 CEOs, and the CEO from Visa is now the CEO of Wells Fargo since 2018. So it's hopefully big changes. So Morningstar has a price target of $40.29, and the current share price was around $32 when I wrote this.
31.
And my own price target was $55. $55 for Wells.
Positive.
If you guys are looking at my charts here, the technical charts, it's like, Wells Fargo looks very different chart-wise compared to the JP Morgan, the XLF,
True.
which are all making all-time highs or about to make all-time highs.
I'm pretty bullish, if I can say that, on Wells, but on the banking industry as an average, bullish, but Wells is probably the biggest bet. I could go more into that, but
I bought Wells stock because of you, and I'm losing money.
Yeah, exactly. I don't. This is the one. Was honestly with the price ranges, I always kind of use a range.
Yeah.
Because my price target is meaningless. It really is. It's just a kind of a guesstimate of where I think the future prospects will be. And with banks, you're pretty certain if you have some of the bigger banks that your price will be somewhere close to the average. So I just used the recent numbers that came out, by the way, to get some of these valuations. And then this Bank of America, Morningstar's rating. Morningstar's price is $32.39 price target. The current price was $31, somewhere there. When I wrote this, I'm not sure where it is at today.
$31.56.
$31.56, and my price target was $26.35.
Oh.
So I think it's pretty obvious. I'm making a bet on Wells Fargo to kind of improve, and not to get too much into it, but it's a bank that's been around since the 1850s. It's one of the oldest. In 2016, it was one of the largest banks, market cap-wise, obviously before certain scandals came out, and they got $3 billion fines and all that. But its business core value is to provide quality to its customers, be it retail, consumers, etc. And I like it more because it's not in the investment banking industry as much as the other banks. It's stuck to its commercial banking branch. So it just focuses on doing loans and deposits. the real economy. Investment bankers are in the business of pricing stocks and not valuing stocks. So it's a tricky industry. Their calculations are more difficult. That's why I didn't go into JP and Goldman Sachs, because they specifically Goldman Sachs more than any of the other banks focus on investment banking services, but these guys are more commercial bank, just a traditional 1850 bank. You come and put your deposit. We tell you how to invest that, or save your wealth, create cash flow, that kind of stuff. Moving away from the bank, but keeping on the tangible economy, I want to look at Canadian National Railway and Canadian Pacific. Yeah, I'm a fun guy at parties. People are touting their Tesla stock, and here I am pitching Canadian National Railway.
But it's making new highs too.
So which one is this one? Canadian National
Railways.
My price target Morningstar's price target for Canadian National was $90 per share. So this is a consensus of analysts on Wall Street, and then their own analysts. They believe the price target for it should be 90. And then I think Canadian Pacific the price target was 270, and the current price is $400 per share. The last, I think so, or 300.
I'm looking at the US. The US
one. Okay.
342.
So the big question now is, what is going on here? Why are the values so high? My own price target for Canadian National was 77, and for Canadian Pacific was 250 Canadian. And this is because of a cyclical trend in investor appetite, specifically institutional investors. They're kind of moving into safer assets. Safer because railways have been predictable. I think it's pretty hilarious. I think it was in the 1800s or somewhere there where railways were the Tesla of the days. There was a railway bubble. People were buying up railway stock like it's Tesla, saying this is going to the moon. This is technology.
This is why a lot of like some people say old-fashioned, but a lot of like the older financial market guys, they actually look at the Dow Jones transport index, because railways are the biggest part of the transport index. And like TK just said, back in the day, they were basically the tech stocks.
They were the tech stocks back then. And I wanted to look at these, was it 5? Yeah, 5 companies, because they've been here. They're older than most of the people buying GM puts and stuff like that today. And it's just kind of to hit home on that long-term perspective again, that, okay, it makes sense to, make a buck or two today on bets you think are sure. But if you want to preserve wealth over time, there are time-tested ways to do it. And I'm not saying go out and buy a passive index fund of 500 companies and just, forget about it. That's very difficult to do when you go to your barbecue. Well, not in COVID, but you go to your barbecue and, Jimmy there is telling you about how much is 7,000% in 20 minutes. It's hard to sit there and not allow that to get you. Mm-hmm. But over time, we see these bubbles of interest in the market. And because people are really interested right now, I've kind of pulled back my interest and my buying. But that's just my style. And I focused more on the tangible economy. And Vishal has talked about this. He talks about oil. He talks about some of the hard economy, the coal. We've talked about coal before. And that's not because we're boring old timers. It's more of there's more tangible value to that right now, because there's not much of a disparity between reality. I think there's more inefficiencies there than there is in the hot stocks right now. Mm-hmm. So yeah, I'm pitching Canadian railways and American banks for the win.
Well, there you go. Daryl Cooper, one of our viewers, agrees with you.
Thank you, Daryl.
He said it's the needs of the economy versus the wants.
Yep.
Ooh, I like that.
And I mean, take a look at like Warren Buffett too, right? His largest acquisitions recently has been a natural gas company. A lot of people are going back to the utilities because utilities are something that will always pay a dividend, and everyone's going to be using energies. And then, of course, oil, gas, that kind of stuff is technically a hard asset. It's a commodity. And I think we've talked about this in the past, but if we look at the CRB, which is the commodity index, and if I go out on the weekly chart, I think commodities are quite undervalued, and they still have some room to go to the upside. So that's why I am big on hard assets, especially if my theory or analysis on the currency war and the fiat money being devalued by central banks and governments come true. You probably want to be in anything other than fiat currency.
Yeah, especially right now, especially with how much of it is flowing freely. It's pretty scary to look at the institution that is creating the fire to give you protection from the fire. That's how I see a lot of what the federal bank and the central bank does. They'll sell you treasury protected bonds, but aren't they the ones who make the target for inflation? It's just fascinating to think about. But there we go. But yeah, I think the nail in the coffin here is kind of, as an investor, it's kind of difficult in the moment to really assess what's going on. It's always easier with hindsight, and that's the worst part about the game. But it's always kind of better to sit back and watch the poker game play out, and only make bets when you think you have a hot hand. For those who don't play poker, I just spoke nonsense there. But for those who do, yeah, it makes a little.
Alrighty, I'm gonna pass it on to Galen.
All right, try and make this short. Sorry.
A lot of
all right.
today.
Yeah, a lot of topics. We covered a whole bunch of stuff. What I wanted to talk about briefly was what the new Biden administration means for the economy and or trading and investing in stocks. It's an interesting transitional period. We are going to see, more stimulus packages. We're going to see, there's the housing shortage that we have to deal with. Retirement savings have gone the way of the dodo, so that has to be rebuilt. The capital gains tax, that's all being reformed, as we know that Yellen is considering taxing the unrealized gains. And also they're wanting to deal with secondary education and making student loan debt cheaper and easier accessible. How is this going to, the Affordable Care Act, which has been, the hot potato that nobody wants to deal with. Mm-hmm. How is these directives and these initiatives going to impact how the stock market is going to perform over the next 12 months? Is it going to put a hold on the spur, or is it going to fuel it even further? Mm-hmm. Are we going to see big tech being taken down? Is Facebook going to finally get a punch in the mouth? Is Google going to get the punch in the mouth? How is that going to impact trading? It's going to be really interesting to see what happens over the next little while. Trump was sort of touted as being, business friendly. But as far as I could see, it was only business friendly if he thought it was friendly. It wasn't necessarily business friendly, right? Biden has a lot of conflicting appointments. A lot of people from big business being entered into the Treasury Department and also in other financial departments, which leads me to believe that we're not going to have an independent governance when it comes to big tech and other types of companies. So what are we going to see over the next 12 months? What's going to happen, guys?
That's going to be interesting to watch over time. I think politics has kind of sunk into business before. I think, I don't know, not to be the guy who quotes Aristotle, but,
I love her.
but he said that commerce and politics should be separated, but should be one. Which is pretty confusing when you think about it.
Fuck Aristotle.
Well, I mean, that's always been the biggest thing, right? In separating politics and business. But I think all you guys know who follow money, right? It is generally the corporations and the rich who donate to the political parties, right? So
it's the kingmakers rather than the kings.
Yeah, and we know Facebook donated money to the Democrats this election. You're not donating money to say, hey, I can't wait till you win, and then you can raise taxes on us, right? Only fools do that. If you want to be a fool, go ahead. But we all know we follow the money. The wealthy people and corporations do not donate to political parties to say, we can't wait for you to win, so you can raise taxes on us, which is hence why taxes always generally go up on the middle class. So that's what I see going. It's not going to change.
Do you see taxes going up on the middle class?
Well, I think so. It's easier.
It's easier.
It's easier to do.
Yep. And
there's not much.
And the way they're going to do it is they're going to do it through the green energy, in my opinion, because that's the way to sort of pass it easier, right? Because obviously no one wants their taxes to be raised in this type of environment. But if you say it's good for the planet and it's for green infrastructure, you're less likely to see people argue, right? Because they'll pay the taxes.
Yeah, no matter
that's
what
I see, right? I think it's pretty obvious that's going to happen. We're already seeing it starting here in Canada. And they're going to use, obviously they're going to say, we're going to use that tax money to build green infrastructure, which has actually been you can read my article from 2 years ago I put up on the tale of $2 on Equity.GURU, but which is why I was looking to go long copper, because this is the next big stimulus, right? This is the next big infrastructure project. It will be green energy, and they will raise taxes on you, and you will pay it because you do not want to kill the planet, and you will reduce your lifestyle to do so, which means that's the easiest way, right? They will tax us, and it's, like I said, it's already starting now, right?
Well, speaking of green economy, then, Maddie, what do we have to look forward to in regards to, green investing, as it were? What's the terminology?
All right.
ESG.
ESG is what it's called. ESG criteria is basically just a set of standards for a company's operations used to screen potential investments. It stands for environmental, social, and governance. So pretty self-explanatory, but environmental encompasses carbon emissions. Social addresses labor relations and diversity and inclusion. And governance kind of just analyzes the internal system of practices and controls and procedures. So this is a really important form of investing, especially for a lot of young people who care about the environment and what their world is going to look like when they get older. So it's just sort of an important kind of movement to get behind. It isn't necessarily the most profitable in comparison to some as of now, but kind of like what Vishal was saying about GameStop, it just like we just all need to get behind something. Maybe that's better than GameStop, and you can make money and help the world. So I think that's amazing. Yep. So that's basically that. Do you guys have any ESG companies that you want to shout out, or sustainable companies that you think look kind of cool?
Well, there's companies like Earth Renew that's dealing with organic fertilization through using pellets of poo that used to get just dumped into landfills up until now and cause all sorts of pollution. And, that the poo problem is actually pretty big when it comes to industrial food production, I guess you could say. So that's one company I'd like to talk about. I think they've got something going on. They are creating power with their conversion. So they are selling that power off to the grid, specifically to a Bitcoin company who's, I guess, mining off of the energy. So it's sort of one of these enclosed systems, which I really kind of like. zero footprint. Every utility is used optimally. Anything that's extra is converted back. That kind of stuff. We don't have a lot of cradle to grave philosophy in our business practices. Mostly because businesses wouldn't be able to support the costs, which is unfortunate because that's kind of really how it all works, right? So it's nice that these guys are now taking a wider approach or a more holistic approach in their business. There's other companies that deal with water purification. Very important over the next little while. Our water supply is now going to become a monetizable commodity and scarce, and it's going to be an area that it's going to produce a lot of income for people that are going to be able to recycle, reuse, and other types of things. So we're going to see more companies like these, and I don't think at one point, there was an idea that these, as Maddie said earlier, the ESG investments were money sinkers. You put your money in because you believed.
Yep.
You weren't necessarily expecting a huge payback on the investment, but you knew that you were doing something that was making good, right? But after a while, as with any economic endeavor, once it gets backed up enough, it will become a money-making endeavor, right? So I think, do you think, I'm hoping, that environmentally sensitive, socially sensitive, governance sensitive investing is a way of the future rather than just sort of a niche market.
Yeah, I mean, I think it's kind of necessary. My editor had sent me a quote, said democracy is the worst form of government except all others. I wrote this in my article. I think the exact same goes for ESG investing. It's the worst form of investing except for all the others. It kind of just getting to a certain point where it's necessary for the world.
So I'm big personally on farming. I think I've made a case, you can read my article on the farming stuff on agriculture. So I think that's, big, and just backing Yellen up on water and waste management and water, right? Reusing water, that's going to be huge. Just a few quick companies I'll go over, but RE Royalties is a green energy company, and I believe they are actually paying a dividend. Not traded too much. No. If they're even still traded, I can't seem to find their ticker.
Oh, geez. Okay, maybe they're gone. Oh, there you go.
They're RE, so they're here, $1.35. But again, volume's not there.
They're an investment house that deals all in green technologies and that kind of thing, right? So you're not just buying into one company, you're getting into a portfolio, and if they've done their work well enough, you're getting into something that's relatively risk-free. Do you know what I mean?
Exactly.
Okay.
And two companies that this is sort of my long-term, so again, this is not a trade recommendation. This is just what I've been holding long-term, and I add here and there for my long-term portfolio. But on the TSX, on Canada, we have the CWW, or the iShares Global Water Index. And there's a whole bunch of water companies and water management and water resource companies. ETF pays a dividend and is just purely focused on water. So this is sort of how I save money or invest money. Every month I put some money into this company. And then I think the one that basically changed my personal stance on green energy and basically profitability is a company called TransAlta Renewables, RNW. Yes, they were, and they do have a gas and an oil and gas division, but they are now moving into hydroelectricity, into wind, into solar, all that kind of good stuff. And they are paying a dividend, which is, it's 8 cents, so it's not much, but it's showing that these type of companies can be profitable, right? Which I find very exciting. And at $22, I think this is sort of my big green energy government infrastructure play. I also do like copper and silver because if you want to build more solar panels and more wind and all that kind of stuff, you will need copper and silver and all that kind of stuff. So definitely two companies I think you should have on your radar.
Joe, there's to be a devil's advocate for a bit. There's a book that was suggested by Bill Gates, The History of Energy. I think I might be Forgetting the book. I think it's called The History of Energy, something like that. But he goes over some of, the history of the human need for energy since, fire. And he talks about some of the case studies that have happened, the studies. The author of this book, not Bill Gates, they go through some of the case studies that have happened over time about humans and their energy needs and our energy consumption. We're always at a point of inflection where we're not too sure what the next best thing is to use to be more energy efficient. And his basic conclusion at the end of it was efficiency does not mean ethical or effective. It just means doing the best for the resources we have today. Mm-hmm. And kind of pushing on to what Vishal is saying about the copper thing, we're going to see more more pollution, more waste as we transition.
Exactly. Yeah.
Because we're gonna need the coal to take the stuff out. We're gonna need the oil to do. So it's like, I get why we do ESG, but Shell and BP are ESG efficient right now.
Yeah.
Shell and BP.
Yeah. People
the biggest
forget,
polluters.
Right? Yeah. Well, people forget we've been mining or taking oil out for 100 years. So government restrictions have been very tough on oil, and the technology has improved, right? Which is why it's more dirtier mining lithium for electric vehicles than it is drilling for oil. Look at the Saudis, look at the Russians, look at their tech, right?
True.
We here in Canada still have like pipelines going from the 80s, right? So
exactly, it's like the definition of it is pretty subjective, and there's some guidelines that they give to companies to meet the standard, but they're pretty subjective. So it's like pick a fight. Obviously, it seems like I'm being negative on ESG. I'm a big supporter of it. But any company can go into an ESG standard and then go into an ESG index just because
they're saying it's like growing organic food. Nobody knows what the hell you got.
It's not to say this, but for example, the social one. If you hire a couple of women or a couple of black guys, you can meet the standard.
Mm-hmm.
But it doesn't mean they're good at their jobs.
Yeah, it doesn't mean and that's the problem.
That's true. In the article I wrote about ESG, I talked about how I wrote this whole article and then I told everyone to go do their own research. Just the least informative, because it really just depends where you stand. If you want to create a portfolio with like really low carbon footprint, or if you care about women in managerial positions, like it is really difficult to gauge. So I think sort of the idea behind it is great. But what it really is just saying is like, look into the companies that you're investing in.
True.
And make sure that you believe in what they're doing, or at least don't hate what they're doing.
That's true.
And it's funny because, like me, TK, and Galen, like you see how we've sort of, on our ESG investing, we're sort of narrowing it down to resources, right? Like physical, tangible stuff, because I think there's definitely a case, right? Like we said, the green energy taxes, all that kind of stuff. And I think, green infrastructure is definitely coming. So that's why I see that as, for sure a place where you want to be in the future. And I think, money is already getting positioned in that, right?
Sure. Yep. It's weird to have an economy where more money is flowing than to creating environmental infrastructure that benefits the society. It's a weird relationship.
On that great note, I'm going to end us off. Thank you so much for listening and joining us, and we will be back next week.
Absolutely. Bye, everyone.
Thank you.
Everybody.
Bye. Hold on a second. I got to do this properly. I'm going to make it like we're actually professional. Here we go.